Hey folks, thanks for tuning in to this month's market update. I wanted to highlight our Cardinal Elite Down Payment Assistance Program. It's a great program. It's compatible with FHA. And the great part about the program is it's very user-friendly. So there's really no overlays if the client qualifies for an FHA loan, and most likely they're going to qualify for this down payment assistance. I just put together a proposal for a client for a $400,000 sales price, and if you're doing a typical FHA loan on $400,000 sales price, you're pretty much looking at, clients looking at a $3,000 a month mortgage payment with and have to bring in around 24,000 funds to close, somewhere in there. But this program allows them to borrow 20,000. It would add 250 a month to the payment, but it would significantly reduce their funds required to close to around $7,000. There's a cost to do the program. That's why it doesn't drop the funds to close by 20,000. But still pretty significant in terms of breaking down the barrier to help a buyer come up with their funds to close. And if you're able to find a seller in this market that will contribute 7,000 towards closing, this could truly be a zero down option for the buyer. You can also couple this with a 2-1 buy down. So let's say, for example, the rate was 6.75 today on an FHA 30-year fixed. Year 1 would be 4.75. Year 2 would be 5.75. Year 3 would be 6.75. And in that first year, they would shave about close to $500 off the payment. And in year 2, they would shave around $250 off the payment, at the expense of about $8,000 for the cost of the buy down. So if you had a seller contributing, call it 7,000 towards closing, a buyer can get into this program with 8,000 funds to close and a mortgage payment of around 2,500 a month in the first year. So if you have any clients that are interested, message me. Thanks. As for mortgage rates, well, we're still stuck at around 7%. The average, or the 10-year U.S. Treasury today is around 4.35, and the average 30-year fixed is just over 7%. Actually, according to Mortgage Daily, Mortgage News Daily. They come out with a survey every day, and what they do is they pull the average offering or the average rate offered by mortgage companies. They toss out the companies operating at a loss. But I like their average better because Freddie Mac uses an average based on files submitted to them, and there's going to be a lag there. So you can see in the link below in the chart where Freddie Mac's average 30-year fixed is published today at 6.75. But Mortgage News Daily is published at a little over 7%, and that's because Mortgage News Daily is real time and Freddie Mac's lagging. If you looked at mortgage rates a couple of weeks ago, they were a little lower, and that's why Freddie Mac's published average 30-year fixed today shows a little bit lower. But yeah, I mean, still above 7. Some silver lining, some hope on the horizon is that the average spread between the 10-year U.S. Treasury and an average 30-year fixed, usually around 1.5% to 2% historically speaking. And for the last 2 years, that spread has been nearly 3%. So, so we're just waiting for that gap to close, and then of course for the bond market to improve as a whole. And hopefully someday soon we'll start to see lower interest rates. I finished going through the May sales for Southern Nevada, and it's pretty interesting. We've all had discussions with our clients about, should we wait to buy and for the rates to drop? And we've all felt that no, it's probably not the best idea. But here's some interesting hard data that sort of back up that claim. May sales for the year to date is virtually on pace identically with last year's sales. So just over 15,000 transactions so far this year, and it's off the pace by 51 sales from 2023. So even though sales pace is slower slightly than last year, which was the slowest in about 15 years. Median price home for May was up to 473,000. The average price home was just over 600,000. So this is a 7% increase from May of 2023. On top of that, rates are actually 0.5% higher than where they were in May of 2023. So if a buyer had waited last May to buy their house this May in hopes of rates dropping, they would have lost 35,000 in home equity. The rates would have been 0.5% higher, and their payments would have been 400 more a month. So, the data certainly tells the story that it's not just a sales pitch, that, someone's going to be better off buying now versus later. There's hard data to back that up. Hope you're all having a great summer. And if there's anything I can do for you and your clients, by all means, just message me. Take care.